welcome to this Philips African Dialogues. The focus today on innovations in strategic infrastructure in Africa. Now, of course, the reality of fast-growing economies across the continent, Nigeria being one of them, Zambia, Ethiopia, Angola, the DRC, of course, the list is growing, and many countries on that list, is that economic and social as well as soft infrastructure gaps are becoming more and more apparent. Now, of course, we've got rising consumer spending, this spurring growth in secondary industries like retail, healthcare, and telecommunications. That, of course, is certainly a good thing, but what it is doing is it needs to be matched by strategic investment in infrastructure. Currently, investment is going into housing, transport, energy, as well as the communications. That, of course, all needed to support competitive, strong economies, which in turn would support job creation, as well as an improved standard of living, so needed in Africa. So the question today we are going to be looking at is how to mobilize new sources of capital. We're going to be looking at current infrastructure projects which are considered landmarks across the continent in terms of how it should be done. We'll look at what investors need to feel more comfortable with regards to putting their capital into larger, long-term, of course, infrastructure projects. And we'll analyze the current approach and see if it is, in fact, the right approach to addressing Africa's infrastructure needs. Let me introduce you to my panel of guests today, starting on the left of me. We've got Ronald de Jong. He is Vice President and Chief Market Leader for Philips. Then next to him, we've got Andrew Ali, President and CEO for the African Finance Corporation. Wale Shangabare, Managing Director for UBA Capital. Welcome to you. And then Opio Oforiokuma, who is the Managing Director for ARM Infrastructure Fund. Thank you, of course, to our panel for joining us. Thank you, of course, to our studio audience for joining us. The most recent developments when it comes to infrastructure financing is the announcement by Obama of the US Presidential Power Africa Initiative, $7 billion committed to infrastructure spend in Africa and the African energy space. Tell us about your involvement there, and tell us about what signal this is sending with regards to infrastructure finance.
Yeah, we're very excited. The African Finance Corporation was one of several partners selected by the US government to work with them on this Power Initiative, Power Africa Initiative. The idea is really to get power investment going in 6 initial countries, which are Nigeria, Ghana, Kenya, Tanzania, Ethiopia, and Rwanda. The US government, through various agencies, has committed something like $7 billion, and then partners like the AFC have committed another few $1 billion towards this initiative. Clearly, power is a major problem across Africa. Most African countries have a power deficit, and it's also necessary to support economic growth. I think over and above the financial commitments, it's also the increased emphasis on making the power sector move. Those countries that have been selected because their governments have also made commitments to the American government to sort of, advance power. And like in Nigeria, some of them have already demonstrated a strong commitment to serious reforms in the sector. We think over the 5-year life of this project that it should make significant improvements in power in the countries which have been selected, and hopefully it will be expanded to more countries as the program progresses.
Mm-hmm. It certainly is being hailed as a positive step, and there's been much said about whether the money is coming from the east or from the west. Most on the African continent are saying as long as it's invested with transparency, it's a good thing. It doesn't matter where the money is coming from. The fact is the money wants to invest in Africa. What are your thoughts on that?
I think it's an excellent development that the international community is focused on investing in Africa and African infrastructure. There was a conference in Barcelona about a week and a half ago where there was significant international interest in the power sector in Africa, both from the east as well as the west. The main thing is that capital doesn't recognize borders. So if there's an investment case to be made, and we've talked about the deficit in African infrastructure, the capital will find its way there. So the main thing is to create the enabling environment to allow that capital to that way.
Let's just talk about the private sector here, Ronald, and I suppose you can bring in the Philips perspective, because Philips is part of the Business Working Group. That was a private sector group that was formed at WEF Africa in Addis Ababa in 2012. Very much focused on trying to provide skills, expertise, capacity to understand the infrastructure needs from a private sector perspective. Tell us about that.
Yeah, before I go in that direction, I would like to offer a different perspective on the topic that we are discussing. I think it's hard to disagree with my colleagues here that we need to make sure that the African continent get access to power. 2/3 of the people don't have access to power. That's not a good thing. It's also not good for economic development. It's good to see that investments are being made to build infrastructure. But what strikes me is that the discussion focuses on the supply side of energy. 7 billion of investments committed. That would roughly add 10,000 megawatt of capacity. According to my sources, $300 billion would be needed to give everybody access to power. What I don't understand is why we cannot follow a dual approach, where we for sure work on the supply side, but where we also work on energy efficiency. As Philips, being the world market leader in lighting, we are committed to drive the revolution from conventional light sources to energy efficient lighting. And let me share with you some facts and some figures. Today around 20% of global energy consumption, electric energy consumption, is related to electric lighting. If you use LED for lighting as a light source, you can save up to 70%. So if we would join forces and be able to change the installed base of conventional light sources into LED-based lighting, you would be able to save the equivalent of 640 mid-sized power plants, or half of the nuclear power plants that are currently available on the planet.
Yeah.
So I think we need to invest and we need to innovate, but not necessarily only on the supply side. I really would like to see more efforts and more collaboration to drive down demand and provide innovations that can use different and harness different sources of energy like solar lighting.
Yeah. Let's talk about the business case for various projects right now. And of course you're very much involved in mobilizing the capital for some of the bigger projects, infrastructure projects right now. What is the approach that is being used really to analyze financing of these projects and bankability? Because is that changing? I know that, for example, the World Economic Forum, for one, put forward how to do this and how to analyze projects, break them down into the various aspects of them.
Yeah, well, in looking at financing, power in particular, you have to look at the entire value chain. So starting from whether it's going to be the energy source, is it going to be gas powered, is it going to be hydro, how is that linked to the generation? So if you have gas, but you don't have the gas pipelines, you don't have the infrastructure to get the gas to the power plants, then as a financier, you'd be worried. So that's the input side of things. After you've generated the power, you have to evacuate it to get it to the distribution company. So who's buying the power? Is that entity credit worthy? Can they pay their bills? So after they bought the power, first of all, you need to transmit it. When you transmit it, you're connected to the grid. You have transmission lines that come up to your power plant. How much losses are you going to suffer in that transmission process? And then which company is buying the power? Then you have to get it to the end users, right? Do those people pay their bills? Are most of them connected? And what's the mechanism for collecting? For collection, so you've sold them the power. Are you going to be able to realize the money? So everything that fits back, the power comes in, and then the money goes back out, and it has to get back to that guy selling the gas in the first place, or providing some alternative source of fuel. All those things have to link up. If there's a weak link in that chain, then it causes problems. That's why you need a framework that works for everybody, because you need a regulator as almost like a conductor of an orchestra to make sure that everything synchronizes.
And of course, bringing in the all-important aspect of government support How critical is that right now? I mean, I know in Nigeria, of course, mass government support for privatization of the power sector. It's up to really the private sector right now to step in. That's where the infrastructure fund comes into play. But talk to us about how you analyze government and its position right now on policy support.
Yeah, I think government support needs to be looked at from a number of perspectives. Firstly, you look at it from the policy and importantly from the will of government. Does government actually do what it says it will do? Another perspective that you have to look at this from is the type of financial support that government needs to give, certainly in the early stages when you're starting up something like this. The story that Wale has just told about ensuring that the end-to-end value chain syncs up is so real. The entity he was talking about that takes the power that is generated is the Nigerian bulk energy trader. And if that entity is not very worthy, then the truth of the matter is that you have a lot of people investing in generation plants. They don't get their money, and very quickly people begin to run bust. And that will now affect your entire system. So there's some kind of financial support that is required to make this possible. And then finally, there's the whole issue about implementation, because even when you bring private investors into the mix, private investors don't take all the obligations, all the risks and responsibilities. Government often has things that it has to do, and that would usually be a continuing obligation all the way throughout the entire term of, say, a concession agreement or whichever type of infrastructure it is. And so therefore, respecting the sanctity of contract and government following through on what it says it will do, how it's meant to do it, and when it's meant to do it, is absolutely critical. All of this is therefore important in building the confidence of investors. Now, I look again back to the first point, the political issue is wrapped also with the political dispensation. Look, when you're investing in projects, I mean, there's no denial that infrastructure is pretty much socio-economic. You can't divorce the needs of people from the economics of the entire thing. That being said, it's very, very important that the regulatory framework that what I referred to is managed in an apolitical way. You shouldn't politicize projects because that scares away investors. So you make a commitment, you've got to see it through. I guess one of the ways to avoid some of the disconnects that happen is very early in the project, usually before you even implement. You must do all your analysis to be very clear what the impact will be on environments, on people, the affordability, willingness to pay, all of those wonderful things. But once you sign the dotted line, you really need to think very, very carefully about walking back from that.
I mean, this really goes back to, an example of where it has gone wrong in South Africa. If you're aware of it, the toll road issue in Gauteng has certainly had everyone having their say. There's been mass strikes, it still hasn't been implemented. And of course, that brings you back to the point of understanding how various stakeholders view a project before you actually start construction. So project preparation, finance, capital for that. I mean, how much, I suppose incubation capital is there out there for these big construction projects?
Well, in Africa, there's been a gap because the most difficult thing is the development capital, the patient capital required to incubate projects, as you said, to build them up to a point where you can then take them out to investors. And there isn't a sufficient amount of that at this point in time. We have organizations such as the AFC who try and fill that role. We also have the InfraCo, which was set up by the development finance institutions. But there needs to be a lot more of that kind of development capital that allows projects for you to do all the required studies and get all the necessary legal safeguards, etc., to be able to make these projects attractive. You have to buy the land and acquire title, etc., etc. And that's a significant amount of what people also call sweat equity that goes into building up these projects. And as more institutions get involved in power generation, we'll begin to see more of that patient capital. But at this point in time, there's a shortage of it. Mm-hmm. And financial investors, such as up here with this fund, will not be able to come in at that development stage because they have obligations to the investors in their fund, which means that they're looking for cash generative projects. You have to be as close to generating returns as possible in order to fulfill your requirements to your investors.
So I mean, if you're talking about, from the AFC's perspective, what's been your experience when it comes to projects that have been put in the bin, in the trash can, as a result of going through the preparation phase, or perhaps put on the back burner, because you know that they just aren't right, they aren't bankable yet?
Yeah. Well, the AFC, we're fortunate enough that we have a large balance sheet. We've got a balance sheet size of about $1.6 billion today, which allows us to put a pool of risk capital, because this is also, it may be the most important part of developing infrastructure projects, but it's also the riskiest part. We have a pool of risk capital, and we also have a team of experts who have experience in developing projects in a variety of sectors: ports, power, roads, etc. So we have a project development facility which does this, because we believe that this is actually the major gap today in infrastructure. It's actually not the financing per se. There are people like Opio and ourselves even who are looking for good projects to invest in, but it's actually the availability of well-structured, bankable projects. Now, I have to say that we're fortunate enough that most of the projects we've done under our project development have actually succeeded. So I don't really actually have any examples to tell you directly of projects.
But perhaps because there was that time and there was that preparation that went into it.
Yeah. I mean, we've done a couple, one in Cape Verde, which is a wind farm project called Cabiolica. That's been up and running now for about a year. It currently provides, I think, something like 25% of the power to Cape Verde. That was something we came into the later stages of project development, where they needed a little bit of money and a little bit of expertise to sort of complete the financing and get it over the hump. I have to say that in our own project development, we don't come right at the very beginning, so we want to make sure that there is at least the semblance of a project before we get engaged. And maybe that is also why, at least to date, we don't have any experiences that we can talk about. Clearly, in the fullness of time, there will be projects that we engage in that will have to be beamed for one reason or the other, but luckily we haven't gotten there yet.
Yeah. Now before we talk about Philip's investments, I just wanted to just dwell for a second on another project, a very big project in Cote d'Ivoire that the AFC was involved in, the Henry Cooney Bridge. And it's the issue around that was that it was a different type of PPP. It had a credit enhancement product in there. So tell us about that and what it did, what type of landmark it sets for infrastructure projects.
Yeah, well, the Kuna Bridge is actually a project that has been around for well over a decade. It was actually about to start being constructed when the civil disturbances broke out in Cote d'Ivoire a decade ago and had to be suspended. We re-engaged with the sponsors and a number of other financiers, once the problems had settled down, to try and get the bridge going. It's very important. It links essentially, it crosses the lagoon in Abidjan, and will be the third bridge across that. Now, the issue here was really, how do you structure the government support? And this we did in a couple of ways. Firstly, the government is actually contributing to the equity of the project. And they have a special tax that they've instituted on petroleum that raises funds, and then against that they borrowed and put that into the project.
So ring-fence tax, essentially.
Yes. So they've actually seeded the project, and they provided about a third of the project cost. Now, there are different ways that governments can do financial support. So they could have just paid a fee every year for this bridge, but in terms of looking at the long term of this project, you may not want to rely on that coming in every year, given the ups and downs that you can see. So putting something in upfront, I think, was very helpful. They've also constructed they are constructing a lot of the interchanges that link the bridge to the road network, which is also a very crucial aspect of this. And then they've provided some of the normal support that you would expect from a government in terms of guaranteeing the stability of the tax regime and what have you.
Is this toll roads?
It's a toll bridge.
Toll bridge, yeah.
Yeah, so it's about, give or take 1.5 kilometers across the lagoon. There are 2 existing bridges which are not tolled. So this one, but there's a lot of congestion going across the bridges. And this one links an area, 2 areas that you'd have to go all the way around the lagoon without the bridge.
So it's a very important purpose. I mean,
yes.
270 million euros in total, the capital
That's
there.
right.
So what can we take away from this project? What can be applied to other infrastructure projects, especially where investors don't tend to have appetite for transport infrastructure?
Yeah, I think transport infrastructure often, not always, provides a lower rate of return and is seen as more risky. And therefore, I think governments need to think about how to de-risk the projects up front. Interestingly enough, we're involved in another project in Mauritius, which is also a toll road, where the government is de-risking it in a different way. So in this particular Mauritius toll road, the government is actually raising the debt itself and essentially lending to the project. And then, we and our partners are bringing in the equity. So they're putting that funding in first, and then we're coming in afterwards as well. And then again, they're sort of giving certain guarantees in terms of what they're going to do with the road network, and possibly actually making some annual payments to top up if the traffic doesn't hit certain levels. So I think that there are different models that can be used, and each model depends on the different circumstances of the project. And so a degree of innovation, creativity, and flexibility, both on the part of the sponsors, as in the government, and also on the part of the financiers, is very important to make these projects succeed.
Innovation in financing, we'll get to that, but I want to find out more about where Philips is focused right now in terms of filling the infrastructure gap. And I know you mentioned lighting, but where are the key sectors? Where do you see Philips' role in the African continent with regards to that?
Well, we for sure see it in lighting, road lighting, city lighting, street lighting, but also in healthcare. So there is a big gap as well when it comes to providing good quality healthcare to the masses. And also there, I think you will see more and more that public parties and private parties are teaming up to provide a solution. That goes for a lot of infrastructural projects. I think the role that government has to play there is twofold. I think one is to ensure that the interest of the various parties that are joining forces to provide a solution are aligned, because that is not a given from the go-get. I think secondarily, what investors would be looking for, and that includes private companies like Philips, is comfort around the risk. The risk that the investment is protected, to your point. And let's face it, many plans span multiple years. Many governments cannot commit to stay in power for multiple years. So political stability is a very important element there as well. I think as a private company, we do realize that we will have to put skin in the game when it comes to big infrastructural investments. But we would be looking at governments to play an important role in aligning the interest of the various investors, as well as providing comfort around the investment made in terms of return, but also in terms of risk.
I mean, one of the examples, a more recent example in terms of where I suppose perhaps the risk wasn't really thought out correctly, perhaps. In Ghana, we had all the latest news is that contractors there haven't been paid for construction of the $850 million gas processing plant in the Tubal. This means that, of course, you've had strike action, workers haven't been paid, and even though the Ghanaian government had budgeted for it, the money hasn't been paid. So even though you had the fiscal budget saying this is how much money is going into it, further down the line, the payments have been made, the project is compromised. I mean, how do you get around those kind of risks, which are going to come up time and time again?
Sure. One of the things that we tend to do as a risk mitigating projects is you seek to take out political risk insurance, for example. You also seek to take out liquidity cover on things like legal. Take for example in the power sector, that's a critical part of what's going to happen to help shore creditworthiness of the end debt organization before the market stabilizes. But I think the critical thing here again goes back to that political risk as a whole that I tried to respond to much earlier on, which is government doing what it says it will do, when it says it will do it, and how it's meant to do it. I think the problem of inadequate budgeting is not unique to Ghana. It's in Nigeria, it's in most African countries, where they engage in a project that will last years, but then you have to go through this annual fiscal discipline. It's good as it is, but it doesn't necessarily connect with the contractual obligations that government has taken on board. Now, I'm not quite sure that's the exact situation in Ghana, but the point is that if you do not budget properly to ensure that you meet your continuing obligations, at some point in time the whole chain will collapse. And of course, when you spread the risk as a private investor with government, you take on board yours. And what we find a lot of the times is that private investors, having budgeted for what they believe they're going to have to do, most likely having put in some kind of contingencies as well, find very, very quickly that the contingencies disappear. And then what you end up with is this overall destabilization that you've talked about. And the worst thing is that it then destroys confidence in that particular economy. And ultimately, who suffers is the end user, because the assets just get moribund. The investors just get a bloody nose when they go somewhere else. And so it's going to be very important that governments think about this very carefully.
Is this happening more or less from your experience with it right now? Investors with bloody noses and I suppose, once bitten, twice shy taking place?
Well, from my own perspective, I really have to. We help project promoters raise money, and we also advise governments on how to structure projects that are appealing to investors. So the key emphasis is in the preparation. If you've done good preparation and you put an appropriate risk mitigants in place, then investors theoretically shouldn't get bloody noses. So things like having fixed term contracts agreed with reputable contractors. For me as an investor or as an advisor to an investor, the key thing, I'm actually backing management, because you can have as many projections in your plan as possible. You need people who are going to make that happen. So the management needs to be credible. They need to have a track record of having done such projects before, and you need to have confidence in their ability to deliver. So I think that's the key thing. You often have these problems where projects have been done very hurriedly, particularly the high-profile political projects, where there's, maybe the president has set a date where something has to be done, and you're not dotting all the I's and crossing all the T's. That said, even with the best preparation, some projects do go wrong, but that's the real world. Things go wrong and they have to be restructured.
If I can add though, I think on a very macro level, UNCTAD, United Nations Trade and Development Organization, does studies on FDI and continuously shows that you get the biggest returns on FDI from investing in Africa. And so I think that on a very macro level, certainly investors aren't getting a bloody nose. But certainly on a micro level, yes, there are projects that have gone wrong, which I guess are balanced out by those projects that do well.
Can I just reflect a bit upon the discussion about bloody noses and risks and returns? There is one word that I miss in the debate so far when it comes to development of infrastructure, and that is the notion of sustainability. And I know it's a notion that is often used, so it tends to lose a bit of impact. But take this example of Power Africa. Adding 10,000 megawatts to the capacity to make sure that you get more of the existing population give access to electricity, knowing that the population is likely to double on the continent in the next decades, the impact on the environment by just working on the supply side is something that we should discuss. We discuss bringing parties together, public parties, private parties. We talk about risk and returns, about comfort, who should play which role. I mean, the bigger concern for me is not only whether investors can get a bloody nose, but also whether the environment is not getting a bloody nose if we just keep building power plants. If we want to create the same level of wealth on the African continent the way we have been developing that in the Western world, there is no denial that the impact on society will be detrimental.
How much then energy, time, resources is put into understanding the environmental impact of projects before construction starts?
I think, well, certainly it's now the custom, it's the norm. When you do major infrastructure projects, you will be obliged, you certainly hope to raise financing, especially in international markets, to conduct your environmental and social impact assessment. That's a given. Without that, in fact, you have the IFC World Bank rules and guidelines. If you don't pass that test, you're not likely to get what you need. That being
Are these
said,
stringent enough, though?
are they stringent enough? I think it depends on which part of the world you're operating in. If you're trying to invest in Africa, where the environment really is not something that is at the forefront of people's thinking, you only need to walk in the streets and you see garbage piled up and you see people, urinating in open sewers and things like that. And the environment has never really been at the forefront of our thinking here because we are not as developed as that. So when you apply those rules in this environment, believe me, they are stringent. But I mean, back to Ronald's point about sustainability, I think it's a bit more than a set of rules. It's about a culture. It's about a state of mind. And looking for more energy efficient ways or technologies is something that has to be there. I agree with you entirely about looking at it not just on the sales side, but also on the consumer side. You know, consumers being more focused on conservation, water, power, and other forms of usage. Even when you're using roads, I mean, do you necessarily have to drive a car with one person? You could carpool. You could save on emissions. You could save on wear and tear on that infrastructure. So really, what we have to do is to go beyond the rules, which themselves I think are rigorous, to actually a culture of environmental sustainability. And I think that ultimately will pay dividends. Now, in a place like Africa, where already poverty is very, very low, this is so important to people. And I think both of those things work in tandem. Now, there's another debate that I think can emerge from this here. Whilst Africa, on the one hand, is being pushed very hard to be very environmentally friendly, the reality is Africa is still very well behind in development. Especially where the pressure is coming from. It's coming from northern hemispheric countries that already have developed and who arguably have polluted the world with heavy industries and things like that. So I'm not quite sure what the balance is, or the right balance is, but the critical thing is that Africa must be allowed a reasonable chance to reduce poverty levels. And there is no doubt a price. I'm not saying we shouldn't watch the price, but we should be allowed to do a bit of a catch-up and not being held back because we're not yet to the standard that can give you the most energy efficient or other types of solutions.
Yeah, I fully agree with Opio there. I mean, AFC takes, environmental, social, and sustainability issues very seriously. We have our own policy, which is as stringent as any, from the World Bank or IFC. It's in fact modeled on that. In fact, right now we have a team in Akwa Ibom State working on something around that. And we also support things like renewable energy. So we've got a wind farm project in Cape Verde that I mentioned earlier. We're working on geothermal power in Kenya. We're also developing a power plant, a thermal power plant that will operate off gas in Ghana, but it will be the most efficient power plant in Ghana once it starts working. That project is called SenPower. So we take those things very seriously. But I think there needs to be a balance as well. I mean, I think that in a way, Africa shouldn't be, because renewables, we support them, but are often more expensive than the alternatives. And so we shouldn't be forced to pay a price for pollution that has been caused by other people. That doesn't mean to say that we should also shoot ourselves in the foot and pollute our own environments going forward. And there needs to be a balance.
And it is also, it's also balance with nature. I mean, of course, we forget sometimes living in the cities that Africa is also about, wildlife and about wide open spaces. And as the continent grows, as you have bigger cities and as you have, roads constructed to be able to connect certain cities to ports, you take away certain migration, land patterns are impacted for wildlife. So that, of course, is something that you have to consider.
Yeah, it's a difficult balance to fix, and I think it's a balance we need to be aware of. I mean, I take advantage and I go for safaris and things, and I like that. But I think, if you tell a village, oh, we can't build a road to connect you to the nearest town because, we want to preserve the environment, they're not going to be very happy either. So some sort of balance, some way of doing this in which, the minimal impact is caused on the environment needs to be found. I think a lot of that can be found one way or another in technology. And one of the advantages that Africa has in terms of being relatively backward in the development of infrastructure is that we can afford to use the latest technology. So I go back to the power station I mentioned. This is probably more efficient than 80% of power stations in, just to name one, the US, simply because it's using the latest GE equipment rather than equipment which is 10 years old. Some of the energy saving innovations that Philips have in terms of on the demand and usage side will also reduce the requirement for energy, and therefore your economic growth can be done in a much more energy efficient way than maybe it has been done elsewhere. So I think that with all these things, there's no one silver bullet that's going to solve the problem, and people have to be aware about it and work from many different angles to try and come to the best compromise.
Certainly you do bring up the value of being behind the curve, sometimes being able to leapfrog all the technologies and, of course, solutions. On that note, let's take a quick break. More, of course, on solving Africa's infrastructure problems after this very short break. So do stay with us. We'll see you in 2 minutes.